Welcome everyone to another Master Investor webinar with me, James Faulkner, and the Master Investor himself, Jim Mellon. We've been absolutely inundated with questions for Jim, so thank you everyone for your submissions. Unfortunately, we're not going to be able to cover everything, but I've tried to structure today's discussion around the main topics that people have shown interest in, so hopefully there'll be something in there for everyone. We'll then have a more general Q&A at the end to answer some of the questions that don't fit into those topics, so please keep your questions coming via the Q&A button on the Zoom navigation bar that you'll find near the bottom of your screen. As ever, being a live webinar, we are at the mercy of technology, so please do bear with us if we encounter any problems. This webinar is being recorded. We will send you an email tomorrow with a link to the recording, or you can find the video recording on our YouTube channel and an audio recording via our podcast. To help us to continually improve our webinar offering, we'd really appreciate your feedback. So at the end of the webinar, you'll see a link to a short feedback survey. It'll take just a couple of minutes, so please do share your thoughts. Finally, a date for your diaries. Our next webinar will be on the 19th of August at midday, where I'll be talking to NetWealth about retirement planning and the long-term impacts of COVID-19. There'll be a link to sign up in the email you receive tomorrow, or you can find the sign-up form on our website under upcoming events. So, Jim, welcome to the webinar. Now that you've been released from captivity, has your view of the markets changed in any way, do you think?
Well, I'm in Ibiza, and actually it's so hot here that I'm kind of dripping away, I'm afraid. I put on the air conditioning, so I hope it's not too offensive. Nice guitar in the background, by the way. As you probably know, Ibiza has, I don't think it's got any cases, but the British government, in its wisdom, has decided not to let British tourists come here.
Yep.
And, well, they can come, but they have to quarantine for 2 weeks on the way back. So the locals are not very favorably disposed towards the Brits at the moment. You know, it's quite quiet, which is the way I like it. In terms of markets, I wrote in the last letter that you harassed me for recently, James, that, you know, it gets a bit boring writing about just buy gold and silver and you don't need to worry about anything else. But more or less, that's been the case. And I will update you later on about my views on gold and silver and some stocks that people might want to have a look at. But I think they're heading up. And, you know, my prognostication, which is that we are in a disinflationary period temporarily, but that the creation of money around the world, which has been absolutely enormous, and the almost willful debasement of the US currency, will lead to inflationary pressures as soon as things start to normalize. And in some cases, they are normalizing. You know, in Asia, you're getting, you know, okay, there are outbreaks, sporadic outbreaks, but generally speaking, in China and in other parts of Asia, you're seeing a revival and in some cases, economic growth. In Europe, we're having some sporadic outbreaks, but generally speaking, in the case of the UK, we're getting about a 1% increase in GDP per week at the moment. And I think most people, commentators, are surprised about the robustness of the V-shape. The United States is another matter because they were recovering very fast, faster than most commentators would have thought, but then you're just seeing record numbers of cases, and that is putting a dampener on both market spirits and also on consumer behavior. So I don't know how robust their economy is going to be, but generally speaking, we're in a period of revival, much anticipated by the stock markets. And that revival will eventually lead to inflation. In terms of the stock markets themselves, I think we are absolutely peaking in some markets, notably in the United States, probably in some European markets, almost certainly in some Asian markets. And this is not a time to be running into stocks. And it's particularly not a time to be running into the stocks that are beloved of Robin Hood and his merry men in the United States, who have a sort of cult-like following, so, you know, the bros who are basically gambling in anything that moves. And I mean, I'll just give you one illustration of that. Some of you will have read about the Kodak company, which I remember visiting when I was very young as a fund manager, trying to get some of their pension fund. Kodak, as someone was pointing out to me today, invented the digital camera in 1975, didn't do anything with it, and as a result went into bankruptcy in 2012 and a slow period of decline. It subsequently has tried to reinvent itself, and the latest reinvention is it got a loan from the US government earlier this week of $750 million to make drugs for coronavirus. And the shares have gone up 1,500%, such that Kodak is capitalized when it's basically got nothing at 1.5 billion US dollars. And that's the result of all these bros playing the stock market as if they were in Las Vegas. This will end in tears. This is a momentum game. It's like pass the parcel, but with much higher stakes. And it is indicative, in my view, of a very frothy market that's probably, well, we know it's priced to perfection, but probably riding for a fall.
So in a sense then, Jim, what you're saying is that you're essentially positive on the recovery and the sustainability of the recovery, but in terms of the stock market, you're actually quite skeptical at the moment.
Well, the Fed made a very important statement yesterday, which, you know, is kind of couched in its usual dry language and obfuscation and, you know, just very difficult to read. But the statement was like Draghi made in terms of the Eurozone when it was in its deepest crisis about 10 years ago. And they'll do whatever it takes to ensure a recovery. So normally, having grown money supply at an annualized rate of about 30% in the last few months, they would be reining in. And they are reining in to a certain extent, but not very much. So we can expect all this money to have a continuing elevating effect on the stock market, keeping zombie companies like, for instance, Kodak alive. We're going to have a very different tenor to the market. So if the recovery does persist, then you'll see what you might call cyclical stocks doing better than the leaders, which have been the FANG stocks. And indeed, there's already some evidence of that. And you'll see the stay-at-home stocks, like, for instance, the mechanism that we're doing this call on at the moment, Zoom, are almost certainly being deflated. So I think it's a time for extreme investor caution, which is why I just write my letters in a rather blasé way and say, hey, you just need to do one thing, and that's buy gold and silver. Because, you know, in a world of negative interest rates, which we're in at the moment, and by negative interest rates, I don't necessarily mean that the interest rates themselves are negative, but adjusted for inflation, they're certainly negative. Gold always does well. And indeed, silver, its poor relation, does well. And I'm going to have a precious metal recommendation on top of the silver and gold, because it gets a bit repetitive when you ask me at the end of this webinar, James. There's a special parting gift to make sure that people don't drop off after 10 minutes, but they have to go right to the end for the metal that they need to be buying now.
Well, we'll be looking forward to that one. In terms of the risks in the market at the moment, when you look at the US market in particular, and you see that a huge amount of the market capitalization is concentrated in a handful of companies, what does that worry you?
Well, it should worry everyone, really. And I mean, there are various layers of worry. One is, we know what happened to the banks after 2008. They were blamed for the crisis, and in some cases, rightly so. And they paid a very heavy price for their social pariah status, and they were fined vast amounts. I mean, I think we're talking about $300 billion between the American and British banks in the last 10 years. And, you know, they found a reason to fine them, even if, you know, the reason was not necessarily fair. The new banks will be the tech companies which don't pay much tax, as we know, which have, in some cases, malign aspects to them, which have, in the case of one or two of them, destroyed the retail base in the traditional way. And they will be the ones with cash-rich balance sheets strong cash flow that will be made to pay the piper. So that's a negative for them. The second thing for them is that they will be subject to the laws of Schumpeterian destruction, like all businesses are eventually, which is that someone will come along and develop something better. And you know about TikTok, right? The ByteDance Chinese thing. You know, that will not probably be allowed to carry on because it's Chinese, but someone's going to come up with a better Facebook or a better Instagram or a better search engine, or we might not even be using search engines. There'll be something new that comes along that destroys these companies, or at least destroys some of their current level of valuation. So that's another one. The next one is regulation. And you know, you saw the 4 of them being interrogated yesterday, all sort of pasty-faced nerds on the by the Congress.
Yeah.
And actually, it was a good interrogation. It wasn't just one of these fob-off type of interrogations that they normally face. So I think the might of the US government, and certainly the European Commission, is bearing down on them. And of course, Asia is largely closed to them because of Chinese tech war with the United States. So just stay away from them. You know, that something will blow up. Why go into something that's priced for perfection, that is highly concentrated in terms of ownership by funds? And the other thing, last thing I want to say is that since the last crisis, the ETFs have taken over a very big chunk of markets everywhere. And when the ETFs buy, they have to buy whatever index or whatever basket or whatever they're following. So because of the concentration of ownership in the stock market in ETFs, it means that these companies are way overrepresented. They're like, I mean, there won't be many people on this call who remember it, but nor do I for that matter. But there was something called the Nifty 50 in the 1960s, when 50 stocks were, you know, basically the whole market capitalization of the United States. Yeah. If you look at what's left of those today, I don't think there are any, or there might be 1 or 2 left, including actually Kodak, which was one of them, and Polaroid, which was the most expensive of all of them. So just beware, learn from some of the lessons of history, and a clear lesson is that when something's frothy, it's probably time to step aside, even if you miss last 20, 30, even 100% of the upside, because you're playing a game with fire.
And talking about frothy, what about Tesla? We've had a ton of questions about Tesla.
On my list of questions, not questions, but recommendations at the end, and by the way, anyone who wants the slides, I guess, can go through you, James, or Master Investor to get them. But Tesla is, along with Moderna, which is a vaccination company, or vaccine company, top of the short list, because it's worth more than all the other car companies in the world, as I understand it, put together. It's worth that in stock market terms, but it's not worth that in economic terms. And it's become a cult. It's become a set of dice for a gambling table. And if you believe, as has been the case for centuries, that ultimately the worth of a company is the net forward value of all the dividends it pays, or its sale price. First of all, there's no one that can buy Tesla because it's too big now to be bought. And secondly, it's not going to pay dividends for a very long period of time in a capital-intensive business like motors, and it is ridiculously overpriced on any metrics you want to look at it. Now, you've got to be very brave to short Tesla. I know that Evel Knievel has flirted with it a few times in the past, but I would say absolutely now.
Hasn't he?
Oh, well, yeah. And he did get Wirecard right, I have to say, and it took him a long time to do it, but he got it right big time. And he'll be right on Tesla as well. So I would definitely, if you can, short and you're prepared to stomach potential volatility, then short it. But, you know, I'm not recommending shorting markets. I'm just saying be cautious and look for alternative investments. And among the alternatives are the cyclical stocks, the ones that have been really battered, that will eventually resume dividend payments. And of course, our old stalwarts, the precious metals.
And I think one of the reasons that people have been so enthusiastic about Tesla is because of its role in the clean energy revolution, which is something that it's one of your meta themes, isn't it? The environment and clean energy. So if we don't go out there and invest in Tesla, what is there to invest in at the moment that might be of interest to
That's a great question. Well,
investors?
energy, clean energy, is clearly a very major theme and will be of governments in the recovery phase of this pandemic. But most energy projects of that type are institutionally priced. So, if you invest in a solar panel farm or you invest in a wind farm, you'll be lucky to get 5% return. And so Tesla's become the kind of go-to, as you rightly point out, speculative counter for people who want to invest in that area. I would bypass that whole area and go to the other two meta themes. One is the clean food revolution, and bearing in mind that the production of food is an even bigger polluter than the use of fossil fuels in transport of any type. It's 1 in 6 of all noxious emissions, and it's about 40% of all methane gases, which are the worst of all these noxious gases that are emitted causing climate change. The reduction in intensive farming that's going to happen in the next 10, 20 years will have a dramatic effect and positive effect on the environment. And the opportunity for people to make money from relatively low valuations in this area is much higher than buying Tesla today, when all the other car companies have got, will have or have got their own electric car offerings. And, frankly speaking, are probably better at building cars and don't have the corporate governance issues that Tesla does. So in this lockdown, as I've said to you before, James, I'm writing a book. It's called Moore's Law. I'm actually making quite good progress on it. It will be out in November, largely because the publishing industry is another one that needs to be disrupted. It takes so long to get things done, as you may know. But it's been a fascinating journey because I've interviewed, thanks to my colleagues, Anthony Chow and Laura Turner, some of the absolute top people in this space, and it is stunningly attractive. So there is a very good report out there called Rethink, which will feature in my book, which posits that in 10 years' time, half of conventional farming will have been replaced. That's just 10 years. So all those cows that people eat, or pigs that they eat, or sheep that they eat, will be on the way to not extinction, but their use in our eating habits will be gone. And that's for two reasons. One is that the plant-based foods are beginning to take hold in a big way. In the pandemic, people have been going out and trying new foods, and they've been trying Beyond Burgers, and we've been trying Beyond Burgers, and we like them very much. They're not particularly healthy for you, but they are contributors to improvements in climate change, and that's a good thing. And there are lots of other plant-based foods out there that cover almost every single type of food that you can imagine. And I'll give you an example. Dairy products, when you go into a coffee shop, if you can go into a coffee shop, you'll be offered a variety of alternative milks today. And, 10 years ago, that alternative milk substitute market was about 0.5% of the US milk market. Today, it's about 16%. So you can see the way it's going to go in meats and other forms of food. Companies are now raising large amounts of money in this area. So Oatly, which you may be familiar with, which is an oat milk substitute, raised $200 million last week as an example of how much money is coming into this area. And we all know how well Beyond Meat has done as a stock market IPO. So that's one aspect of it. The second is that you've got cell ag, as it's called, developing. There are about 50 companies now. I think we've invested in about 15 of them. And they range from would-be producers of cellular meat and meats of all type, chicken, beef, pork, you name it, to producers of cotton in a cellular way, which is very exciting, and they can produce any other plant in due course. Producers of leather in a cellular way, which has amazing benefits, because if you think about it at the moment, the size of a cow dictates the size of a piece of leather. the hype does. And if you can make this stuff in industrial quantities and very large sizes, it's going to substitute the existing leather market. It's going to disrupt it completely. And of course, you can make eggs, you can make, or egg equivalents, you can make dairy products in a cellular way, and cheese, and all sorts of things. And this is happening at a remarkable pace. So this is an industry that really people should be looking at. And the vehicle that we established, which has no management fee, it has a long-term performance fee, but no management fee, is Agronomics, which some people will be familiar with. And it trades on the stock exchange in London. And it's managed by Anthony and Laura, who I mentioned earlier. And I think it will be, our goal for it is to be a $500 million business by the end of next year. Now, the second meta theme is, of course, longevity. And COVID-19 has raised the issue yet again of how vulnerable and frail the older cohorts in society are. And you know, if you look at who's dying in, and I mentioned this on the last time we spoke, in COVID-19, the average age is between 75 and 80, depending on where you are. It's how many comorbidities you've got, how many illnesses, long-term illnesses you have. And you've seen a remarkable outperformance of the biotech industry as a result, because everyone knows that there will be increased spending proportionate to GDP on healthcare, and there will be a great deal of research into how to building immunoresilience into older people. And so that's why I'm very keen on this industry, and why we set up Juvenescence, which is now doing its Series C, and hopefully will go public in the next year or so.
With that in mind, Jim, do you think that the outperformance of the biotech and the pharmaceutical sectors is sustainable? Whereas, because you were talking about before, you know, a lot of the other sectors that have done really well out of COVID, such as the, you know, the work from home sectors and the tech sectors, look really frothy. But what you're saying is you think that the biotech and the pharma sectors can still do really well going forward.
Yeah, I do, but obviously it's a matter of selection like anything else. And you know, it's interesting to me that Pfizer is one of the contenders, world's biggest drug company, pure drug company, as opposed to healthcare company, which is Johnson & Johnson. Has, you know, it's performed okay, but it's not been outstanding, even though it is one of the producers of a possible vaccine for this COVID-19. The same goes for GSK. Astra has done quite well, but none of them have been stellar performers. And yet you've got companies like Moderna, which is now capitalized, I think, at something like $30 billion, which is a one-shot company. Now, either its vaccine works or it doesn't, but there'll be 5 other vaccines as well, which have become a speculative counter. So you've got to be very, very careful in triaging how you invest in biotech. And it's a very big industry. It's a very big area. But it has the potential to be long-lived, largely because the patents on the products that they produce are quite long-lived, whereas technology companies of the sort of work-at-home types don't really have a patent estate. They just have to live by their wits. And if they do have patents, they're very obscure patents, but are not necessarily defensible. And you know, to give you an example, Facebook just copies everyone else's, like it's copied TikTok, it copied Snapchat, it copied, you know, it just keeps on copying. And one day it will cease to be innovative, which is why, you know, I think you've got to be very, very careful with those companies. On the other hand, I've been negative on Facebook for quite a while. I thought it was actually in terminal decline at the beginning of the year, and it's not been the case, I suppose, because people are sitting at home playing on their computers or on their phones all the time. But the day will come, and the best thing to do is to step aside.
And I want to get back to gold, because we had a ton of questions on gold. It's hit new highs recently. It's at an all-time high now, I think. Have you got a target price, and when do you expect that to be hit?
Well, I don't know if you read the letters I write for you, but my target price for gold was $2,500 for this year, I think. And actually, no, it wasn't. It was $2,000, and silver was $25 an ounce.
Yeah.
Now, we're within a whisker for gold, and we've already breached that for silver. So I think we can raise the targets. I mean, I think silver going to $30 is entirely possible, and it would still be way below the high during the period when Nelson Hunt tried to corner the market, which was in, I think, the early 1980s, and lost everything. And the industrial applications of silver, which are substantial, are actually growing in scale. So there is more than just a speculative element to it, then there is also an industrial application. In terms of gold, you're seeing central banks buying more and more of it, particularly the Chinese central bank. And investors are buying a lot of gold as a hedge against inflation, and also because the holding cost of gold now is lower than holding bonds or cash. And when there's negative interest rates, I feel that it's going to go up further. It's broken through an all-time high recently, and decisively so, which means that even though it may chop around at this level as there's congestion in the metal, it will probably go up. And one thing to remember is there's been almost no consumer purchases of gold this year because of the lockdown. And when the consumer is back and running in India, China, et cetera, there'll be a big uptake in gold. The other thing about gold is that there's very little mining output. So I think I'm right in saying that less than 1% of the world's supply of gold is provided on an annual basis by mining and recycling. So the supply is very limited. You've seen the same with Bitcoin, of course. You've seen a lot of speculation in Bitcoin recently. But my preference is for gold. Feel it, touch it, have it in your safe, buy the stocks, and buy the futures or the ETFs. But it's got legs to run. And I hope that everyone, whoever listens to me, has managed to put some in their portfolio, because I'm not one of these gold bugs who's been a gold bug for 20 years. I'm not like one of these guys who eventually the clock stops twice during the day and they're right. On this one, I've been absolutely right, been very vociferous in my call, saying that this is the one asset class you have to own. And I still think you have to own it. But try and trade it a bit if you can. So if it froths up, sell some, buy it back. It's going to be a choppy ride, but a very profitable ride.
We've had some commentators talk about some quite, outlandish targets for gold, $3,000, $5,000 an ounce or more. Do you put any credence in that, or is that just fairy tale talk?
Well, there are two reasons why people might commentate like that. One is to try and get a headline, right, for themselves, and the other, like people forecast in Japan that the Nikkei was going to go to 100,000 when it was about 40,000 in 1989. It's never got back to 40,000 or anywhere near it since then. Or the Dow 100,000 we've heard about as well. And they get their headline, and then they sink back into obscurity, and well-deserved obscurity. And the second reason people do it is because they're wild-eyed and over-enthusiastic, and they're the sort of people who, I mentioned, for whom the clock will stop eventually on their dial, on their bit at the dial at some point in their lives. However, and you've got to ask them, how much money have you got in your bank account? Because probably the answer is not much if they make stupid forecasts like that. But I would say that there is a good chance that gold will go to $3,000 an ounce over the next 2 or 3 years, and possibly exceed that, which is about a 50% increase from here. And I'm not sure you can say that about many other assets. But at that point, you may start to think, well, do I buy gold or do I buy the companies that produce gold? Because the operating economics of those companies are very, very positive. So as you know, I'm a director of a small British gold mining company which operates in Nicaragua called Condor, and it's moving towards production. They've done a very good job in getting it to the point here where they've proved up, a couple of million ounces of reserves. And what I like about that is that you're buying gold in the ground at about $19, which is less than 1% of the price of the gold. So effectively you have a very big discount, 99% discount to the price of the current gold price. You have a call option on gold going up, and you have a production cost, because it's in Nicaragua, that's all in sustaining, including capex, of about $700 an ounce. So the margins are very wide. And when they start producing, which will be not too far off, then the cash flow should be very substantial indeed. It does carry, however, execution risk and country risk And so for that reason, it's, you know, you don't put all your money into something like Condor Gold, but the leverage in those companies is considerably greater than buying an ounce of gold today and seeing it going up by 50%.
And what about the royalty companies, Jim, as well? Because these are, you know, a lot of people see them as a lower risk play into the gold sector. How do they feature in, you know, in your thinking vis-a-vis the conventional gold miners?
Well, I think there are outstanding companies. Franco-Nevada and Royal Gold are the two clear leaders, but they're very well priced. You know, it's all a question of price. And royalty companies, because of the diversification of their assets, you know, they spread their royalties over, you know, many companies, and they're basically legal outfits. I mean, Mark Child was telling me the other day that the Royalty Gold has got, I think, 26 employees, and 24 of them are lawyers, because they're just basically making sure they get paid on whatever is produced by whatever company that 25 years ago entered into an agreement with them. But you know, they're very highly priced. So it's a great idea, and probably you'll do well in it in the long term, but I think you should buy individual gold stocks. And on my list towards the end, which I think Anthony will put up, I've got some recommendations for stocks that people might want to look at today.
Stuff. And so obviously we know, you know, one of the reasons why we're so interested in gold and silver at the moment is as a hedge against inflation. But you talked about deflation being the more sort of immediate threat at the moment. When do you see inflation arriving, and in what magnitude?
That is a very good question, and like any other sentient being, I can't answer it with any degree of conviction. But what I'll say is that, you know, Gresham's law was good money is driven out by bad money, and we're in that situation at the moment. The amount of pump priming, whatever way you look at it, dressed up as modern monetary theory or QE or, you know, all the rinky-dinks that have been dreamt up by various central banks. It's basically the printing of money and the competitive debasement of currencies. That will eventually find its way into inflation. It finds its way into inflation through a combination of rising commodity prices, rising asset prices, and these are real assets, not stock market assets. Property would be a good example of that. And most importantly, rising wage prices. Now, in order to get rising wage prices, you have to have a competitive labor market. And at the moment, when unemployment is rising and possibly going to go up even further, that's difficult to see. However, we know that the socialization of governments everywhere will probably mean a mandated rise in wages, even for lower paid workers, will be higher than otherwise expected. And we know that in some areas, like in software companies or in tech companies or in biotech, it doesn't really matter what happens, wages are going to go up through the roof. And that wage inflation will lead to price inflation. And when we get price inflation, we'll see possibly up to 10% inflation. And just remember that Venezuela was once a very rich country. It was richer per head than the UK at the turn of the last century. Look at it now. It's a complete basket case. Why did that happen? Because the government tried to print its way out of trouble. Zimbabwe was once a bucolic and prosperous African country. Again, they did the same thing. They tried to print their way out of trouble, and they're a devastated hulk, a ruin of an economy. I'm not saying that the same thing is going to happen to us, but what I am saying, as I said at the last Master Investor I spoke at, that 25% of your assets should be in protective assets against that. And those are typically the inflation-linked bonds, so-called TIPS, and particularly gold and silver and anything to do with them.
I'm talking about commodity price inflation. Where does that leave oil? Because historically, oil has been a key component in the inflation indices, hasn't it? So, but today, obviously, we've got a completely different environment. We've had a lot of demand destruction in the oil sector with, things like the airlines and people working from home. Where do you see oil heading?
Okay, so you remember that the contango in March, when the oil price went negative because of the cost, there was nowhere to store it. And there was a big surplus of supply, particularly out of the US shale fields. Since then, there's been a dramatic reduction in production out of the United States and elsewhere for that matter, which is consistent with what's been happening in economies. And as you say, airlines and cars and so forth have been, the traffic with those has gone down dramatically. They will recover, and a good pointer towards that is the fact that heavy goods vehicle traffic in Germany, as an example, is back to pre-COVID levels. And in the UK, it's about 85% of pre-COVID levels, and it won't take very long for it to get back up to pre-COVID levels. And the same in China and elsewhere. Airlines are really a function of these, what I would imagine will be short-term quarantining events, but they will eventually get back to full capacity, and people have not forgotten, but they'll certainly be less aware of the, what happened in this unique and extraordinary period. So my own view, based on reading in the last few weeks, is that there will be a deficit in oil production against demand by the end of this year of between 4 and 5 million barrels a day, and that the price of oil will go back up to over $100. So one thing that you should definitely be doing at the moment is buying oil stocks. And the oil stocks like Shell announced today its results, Total announced their results, and I think a number of the others are about to announce their results for the latest quarter. Were not nearly as bad as people thought, because they're vertically integrated companies. They both produce oil and they sell it at the other end, and somewhere in between in their trading operations they make money. And so 100% get out there, buy BP, Total, Shell. I've got a couple of American ones later on, including Schlumberger, which is the world's biggest oil services company, which announced that they were laying off a third of their employees 2 or 3 days ago. I think COVID has become a very welcome veil for some of these companies that are going to undertake major restructurings anyway, and they can just do it faster and probably cheaper than they could have done pre-COVID. So Schlumberger is a very big company, BP, Shell, Total, big companies. They'll start resuming dividends in due course. But remember that they are all going to spend less money on CapEx as time goes on, because they're liquidating vehicles. They know that in 20 or 30 years' time, fossil fuels will be much less relevant to the world than they are today. And they'll either go down being in the green path to a certain extent, but they'll certainly be liquidating themselves by paying out more dividends. So I think they're very, very good buys at the moment. It's a great question of yours, but I think oil will be over $100 by the end of this year.
If we're confident that oil is going back to $100, shouldn't we be looking at some of the smaller companies and perhaps some of the exploration plays which have been completely bombed out recently?
Yeah, you should, but I don't know anything about them. So, it's not something that I'm conversant with. I think you'd be better off asking one of the other Master Investor contributors maybe to write an article about that. Maybe yourself, James, you could do some investigation. Let me know, give me some inside information on it before you release the information to the market. But I think in a generalized move in markets, it's always the big ones that go up first or go down first. So I think that you're probably better off just looking at the big ones. On prospective dividend yields, things like BP or Shell is 7 or 8%. They could go back down to a 5% yield. Oil at $100, I would think BP would double in price. Right. So, you're not going to go wrong buying it at this level.
Any other commodities we should be looking at right now for the return of inflation?
Yeah, I think you can look at almost anything. You could look at iron ore, you could look at copper, you could look at nickel. The other metal, precious metal that I would recommend is platinum, because platinum is a kind of poor man's, it's a slightly richer poor man's gold than silver. It's very much overlooked, and its industrial applications are very substantial, even in the era of electrification of cars. So
I think it's used catalytic converters, isn't it? So it had a bit of a troubling period due to that.
It did, but there's many other applications that platinum is used for beyond catalytic converters. And we're not at the end of petrol or diesel-driven cars or vehicles. I mean, there's going to be many years before we're fully electrified. And indeed, if there is, as I understand it, if there's a move to hydrogen fuel cells, which is a possibility, then you will need platinum, again, in large quantities for that purpose. But so, you know, I've been accumulating, I've done very well in gold and silver, particularly silver, and I've been accumulating platinum, and it's something that people might want to look at. Again, you might ask me what stocks should they be buying in that area, and I couldn't tell you because I just don't know. I haven't, you know, I don't have, I'm writing my book, trying to keep a roof over the heads of the people who live here, and there's not enough time in the world to do everything. Right. So I'm actually not getting any time to read books, and that's what I'd like to do for this summer, but, you know, I can't bleat. It's not been a bad period. It's been terrible for other people, so I must count my blessings.
Is what you're trying to say, Jim, that despite what people may think, that you're not Superman?
I'm definitely not Superman. I've made plenty of losses and will continue to do so. But as long as you get it right 51% of the time and you lose 49% of the time, and you don't put all your bets into one of the 49%, then you're going to do fine. But as I have two mantras. One is curiosity and adaptability, which is, you know, you've got to be, you've got to move with the times, and you've got to do a lot of reading in your specialist subject. And then the other one is to basically, you know, try and get some downtime to have a different perspective on life that is beyond just the short-term movements in markets. And I'm not getting enough of that. And I just need to get back to that. And don't mean right now, I'm not hanging up the phone or anything like that. What I'm saying is, you know, I would like to read a couple of like novels, or I have been watching quite a lot of stuff on TV. We've watched a lot of box sets. I'm sure you have as well, James. And you've been getting that guitar out.
That's in this house, yeah. Moving on.
Is that a Les Paul guitar there?
To be honest, Jim, I've no idea because I've not played in it about 10 years.
Oh, so it's just showing off, is it? Yeah.
It's more of an ornament these days.
And you even have CDs. Wow, I thought you were technologically advanced.
Moving on to the wider Q&A. So Noel is asking, recent years have seen a massive urbanisation trend of everyone rushing from rural areas to city centres for work. Do you see this trend reversing now that COVID has proved that we can largely work remotely? And do you see commercial and residential prices in cities like London, New York and Hong Kong massively dropping in price?
Oh, it's a very good question. The answer is New York, which has got the same characteristics in some ways as London, has seen a very dramatic drop in its rents recently and in capital values. The same doesn't seem to have happened in London, and I think that's partly because London is more considered to be a safe haven for areas of turmoil. So in Hong Kong, for instance, you know, with the recent developments, there's probably been a lot of buyers of London property which have sustained prices despite COVID. In terms of the City of London, you know, I bought some shares of IWG, which is the sort of competitor to WeWork, because it could be that companies will just rent, you know, short-term space like WeWork or IWG's space, and then employees can work maybe 2 days a week at home and 3 days a week in the office, and the big office projects may be impacted, but I just really don't know. I think the main impediment to going back to the city or cities is not the fact that people don't want to go back, because I'm sure plenty of people do want to go back. It's because they don't want to go on public transport. And as soon as public transport is seen to be safe, we may just be back to where we were before. In other words, they could just be full, and because I don't think that most people would want to be working at home all the time. But I'm not an expert, since I haven't set foot in an office for about 8 years, and I normally work in a coffee shop. Well, I do, you know.
Mark is asking, do you still see value in international consolidated airlines? So this is the British Airways owner.
Yeah, I do. And so we'll strip that down to two components. One is that we know that this quarantine stuff and the problems in the US have meant that the lucrative routes across the Atlantic and in Europe have been diminished for the current year. And in fact, in the case of transatlantic travel, almost cancelled. But we also know that there are some competitive advantages for the big airline groups like IAG or Delta Airlines in the US, which are that the longer this goes on, the more likely that the small minnow competitors are going to go bust, which would play very well to their hands. And you will note that Willie Walsh, who's the CEO of IAG, is saying he doesn't want any government help. He thinks there should be no government help for airlines, blah, 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 because he wants to drive competitors like Norwegian out of business. Now, the other thing of note, which is very different to the last cycle, is that the airlines have got these massive schemes linked to credit cards and to shopping generally, which are air miles. In the case of IAG, it's Avios. And last week, American Airlines got $750 million from, I think, a bank secured against its credit card and loyalty point scheme, which would never been able to do about 10 years ago because they weren't big enough. The most valuable of these schemes are the IAG Avios point ones and the Delta Airlines ones. And that's why these two, which are going to be winners on the other side, are, in my opinion, very good investments. And, you know, Warren Buffett sold all his airline shares at the height of the crisis. Most of the ones he sold are up by about 50%. So he made the wrong decision. But I think we can make the right decision here. So IAG and Delta definitely feature on my list of buys.
Okay. An anonymous question. With regard to inflation, are you saying that interest rates will rise significantly?
That is another great question. And, you know, the last time there was big inflation in the world was about 35 years ago. And Volcker clamped down in the United States by raising interest rates very substantially. It had the effect of promoting pretty vicious...
a little bit depressing.
Very depressive. Also, at that point, the stock markets were very depressed. And of course, from that point onwards, they went up and bond yields went down, and you had a remarkable stock market performance over the last, generation, really. And you've also had the same thing in bond prices. Here, we have the possibility of higher inflation at a time when bond yields are very, very low or negative, and stock markets are very elevated. So I would think that given the political sensitivities, the need to keep economies kind of going, that there's not going to be a stringent rise in interest rates manipulated by the Fed or any other financial institution for some time. But the days of ultra low interest rates are coming to an end. We don't know when, but it could be a year, 5 years, but they'll gradually go up. So if you're able to borrow against secure assets at a very low interest rate today, this is the time to do it.
And isn't this all part of the process of financial repression, though, Jim? Because governments need low interest rates and high inflation, don't they, to sort of diminish the burden, the real burden of the debt?
Yeah, that's a great question. For sure, I think governments will welcome some degree of inflation. And the problem with inflation is that you let the genie out of the bottle, but you can't determine where it goes. And if they think they're going to be able to keep it at 3% or 5% or whatever, they're unlikely to be able to do it once it gets going. And certainly the preference for governments would be to generally to have inflation to reduce the burden of debt by basically inflating it away, as was done with all the bonds that were issued in wars and so forth. However, in recent years, governments have been issuing more and more of the inflation-linked bonds, as you know, TIPS. And in the UK, as an example, 1/3 of all our government debt outstanding is index-linked. And that actually is very negative for governments in the event of rising inflation. Most people don't take that into account because they have to pay not only the bond back, but also the inflation, which could be quite substantial. So it's a double-edged sword here, and I'm not really sure what the answer to that is. But in every single major market, I think that inflation-linked bonds have become quite a major feature. So just having a lot of debt doesn't necessarily mean that you want to have high inflation anymore, whereas it would have done in, let's say, 1945. That having been said, I see the capacity for economies such as the UK to grow quite quickly. As I said, at the moment, the economy is rebounding by about 1% a week. Doesn't take many weeks to get back to where we were. And in that sort of normalized economy, we're going to have a lot of restructuring. The gentleman asked earlier on about the way in which we work. It doesn't really matter where you work as long as the work takes place. And we are a very service-oriented economy in the UK. So our manufacturing base is not substantial as it is in Germany or China, and is less affected by the ability or otherwise to go to a workplace. I think that our economy will grow faster than people think, the UK economy. And I noted today that Germany's GDP for the second quarter was much worse than expected. It was minus 11.7%, whereas they were expecting minus 9%. And that's probably because of their heavy reliance on manufacturing. They are in a very difficult situation in Germany compared to ours. And we have the opportunity now of restructuring our economy in a very positive way. Our stock market has not performed particularly well compared to other stock markets. And maybe now's the time to be loading up on British shares, which feature heavily in the list of recommended shares, which before this thing finishes, I should really put up on the screen, or ask Anthony to put up on the screen. Anthony, if you're listening, which I'm sure you are avidly, do you want to put that list up? Here we go. So, James, should I just go through some of these and just mention a couple of them? Okay, so the gold shares are fairly obvious. We've got a gold share ETF here. It's a big one. It's the SPDR one. It's $80 billion in size. You could trade gold that way. You can also trade gold by investing in gold and silver, that is, in Centamin. You can trade gold by investing in Sandfire Resources. I talked about Condor Gold. There's a tiny little one in Canada, which has been taken up by my very good friend, Steve Detells, who I've done lots of stuff in metals with over the years, including in Uramin, and it's called Paso Fino Gold. And then there's an even smaller one run by a friend of mine in Australia called Dart Mining, which I ended up as the biggest shareholder of. So, there are very big ones, very small ones there. And there's also Pan-African Resources. In terms of oil, which we talked about earlier, I would, plump for the bigger ones. So Royal Dutch, BP, Schlumberger, I mentioned. In the United States, Pioneer Natural Resources, we've just picked up. Repsol in Spain. We've also picked up Diamondback Energy. These are reasonably sized companies. We talked about IAG and Delta. More prosaically, perhaps, I was interested in a well-known investor buying into the BT Group, which is, our major telecom company, along with Vodafone. And I just thought, yeah, I'll buy some of that. So I did. And you know, for 14 billion pounds of market capitalization, you're getting basically the whole backbone of the infrastructure of the UK telecom sector. So I think that you'll do well in that one. And then you've got also the banking sector, which has been an absolute dog. The two banks in the UK that I think are worth picking up at this stage for different reasons are Lloyds, even though it's not particularly well managed. It is a lumbering giant, and it has said it will resume dividend payments as soon as possible. And on a prospective yield of 7 or 8%, it's a hell of a lot better than buying or putting your money onto a deposit with Lloyds. And Barclays, which has, you know, actually is one of the few European banks that has a decent investment banking side to it, is relatively cheap and will resume substantial dividend payments. The banks are in a much, much better condition than they were in the financial crisis. And even though you see a lot of provisioning going on, I imagine a lot of that is due to forbearance, and the money will come back in the next year's accounts. So I would pick up those two as parts of a portfolio. I'm talking a bit, as I always do, my own book in a way, but 5 years ago, 3 of us who founded Juvenescence and a number of other companies founded Biohaven, and it's backed off a little bit, but a couple of weeks ago, it reached a $5 billion valuation, and we put in $3 million for 54% of the company ab initio. Biohaven's got a drug on the market now, and the sales of that drug, which for meat grain, is very under met medical need, are doing extremely well despite the pandemic. So I think that's one possibly to tuck away in your portfolio. Now it's backed off a little bit. So this is a flavor of what I would suggest that you do at the moment. And if you just want to buy an ETF for oil and gas, we've identified SPDR oil and gas exploration and Wisdom Tree crude oil. And what's interesting about that is if you see the size of the gold ETF, gold having done so well, and then you compare it to the oil and gas ETF and the ETFs, they're tiny by comparison. So there's very little positioning, positive positioning in oil at the moment. So maybe you might want to think about those. So that's my little rendition of what you might want to think about buying. And all those slides, James, I'm sure you'll make available on the Master Investor website or however you distribute it.
Yeah, sure. I think we'll leave it there then, Jim. I think that's a good place to conclude today's discussion.
Well, it's very much appreciated. I can see there are about 300 people attending at the moment, and that's really fantastic. And if you're interested, I'd love to do another one in, let's say, another month's time, and we can catch up then and see how things are developing. Because I'm sure that one way or another, we will still be at home, we'll still be using Zoom for a while yet.
Yeah, looking forward to it. Thank you to everyone for joining us today, and to Jim for answering our questions. Just a final reminder that we'd really appreciate your feedback, so please do take our survey. The link is in the chat, and you'll also receive it via our follow-up email. And lastly, don't forget to save the date for our next webinar on the 19th of August at midday, where I'll be talking retirement planning with Netwealth. Thanks very much, everybody, and take care.